Maximize your savings. Understanding certificates of deposit, CDs. In simple terms, imagine you have a piggy bank where you can put your money, but there's a rule. You can't open it for a set time in return for waiting. You get extra money, interest. When you finally open it, that's basically what a certificate of deposit, CD, is. In the banking world, certificate of deposits, CDs, are a financial tool offered by banks and financial institutions that allow individuals and organizations to deposit a specific amount of money for a set period, during which they receive a guaranteed interest rate. It's like a savings account, but with a fixed term and usually a higher interest rate. CDs are available to individuals, corporations, companies, trusts, and various other entities. Even non-resident Indians, NRIs, can invest in CDs, but it's essential to specify whether the investment is repatriable or non-repatriable. There are some legal requirements, such as stamp duty, that apply to CDs like other negotiable instruments. Banks offering CDs must maintain certain reserves like the statutory liquidity ratio, SLR, and cash reserve ratio, CRR, based on the issue price of CDs. There's no fixed limit on the amount of CDs a bank can issue. The minimum amount you can invest in a CD is typically 1 lakh rupees, and you can invest in multiples of 1 lakh rupees. You can transfer your CD to someone else by endorsing it and delivering it to the new holder. It's kind of like passing on ownership to someone else. There's a minimum lock-in period of 15 days for CDs. You can't withdraw your money before this period. Banks usually issue CDs when they need funds for lending because their deposits are not growing as quickly, and there's high demand for loans. They use CDs as a way to raise money during tight liquidity situations. Remembering key points. CDs are like fixed-term savings with benefits. Minimum investment usually starts at 1 lakh rupees. You can transfer them to others. There's a lock-in period of at least 15 days. Banks use CDs to raise money for lending. Think of a CD as a commitment between you and the bank. You commit your money for a certain time, and in return, the bank pays you interest. It's a win-win. You get a safe place to keep your money with a good return, and the bank gets the funds it needs.